From a behind-the-scenes licensor to a frontline chipmaker, ARM is tearing off a label it has worn for 30 years. Its first AGI CPU just dropped, delivering twice the performance per rack compared to traditional x86 systems. Is this ARM's ultimate move to dominate the era of agentic AI, a risky play that puts it in direct competition with longtime partners like Apple and Qualcomm? With a staggering 1-to-0 x divided by e and an extreme peg ratio of 6.0, is ARM the crown jewel of the computer era, a valuation bubble ready to burst? What's up, guys? Welcome back to Stock Market Breakdown. ARM's recent moves have the entire semiconductor industry holding its breath. It's no longer satisfied with collecting licensing fees and wants to build chips itself. This is a historic shift in its business model, and it means ARM is trying to capture the full profit stack of AI chips. But here's the real question. When the referee steps onto the field as a player, will its longtime partners just sit back and watch? ARM is breaking away from its long-standing model of licensing architectures and collecting royalties, and is now fully committing to developing its own physical chip products. This marks a transition from being a behind-the-scenes designer to becoming a direct supplier in the semiconductor value chain. The goal is clear: capture a larger share of the profit pool by reclaiming margins that previously belonged to downstream chipmakers. This is the most aggressive strategic shift in ARM's history, fundamentally changing how profits are distributed across the industry. Before, ARM made intellectual property money, stable, but limited in upside. Now it wants product money. Going from selling blueprints to selling finished chips means revenue per unit could scale exponentially. This completely reshapes ARM's valuation story, but it also means building supply chains and operational capability, something that's a massive challenge for a company that has traditionally been asset-light. ARM has officially launched its first internally developed personal data center processor with ARM AGI CPU. This is not a general-purpose chip. It's specifically designed for agentic AI workloads. These AI systems don't just generate content, they run continuously, plan autonomously, and perform complex reasoning tasks. As we move toward the AGI era, these always-on, high-intensity inference workloads are becoming the next major growth driver in the CPU market, and ARM is positioning itself right at the center of it. Pay attention to agentic AI. Future AI assistants won't just respond, they'll proactively execute workflows. That kind of continuous task demand requires a completely new processor architecture. The ARM AGI CPU is built to capture that incremental market. While NVIDIA focuses on training large models, ARM is trying to dominate the execution layer. In terms of performance, the AGI CPU emphasizes extremely high compute density. According to official data, it delivers more than double the performance per rack compared to traditional x86 systems, while maintaining ARM's industry-leading power efficiency. At a time when electricity supply has become the biggest bottleneck for data centers, this combination of high performance and low power consumption is a decisive competitive edge. It not only reduces energy costs significantly, but also enables more compute within limited physical space. Data centers today don't lack chips, they lack power and space. ARM is hitting x86 exactly where it hurts. Doubling compute density means one data center can do the work of two. For cloud giants racing to scale AI infrastructure, that kind of efficiency is almost impossible to ignore. This is the technical foundation behind ARM's confidence to enter the chip-making game. By selling its own chips, ARM's profit model is undergoing a structural transformation from taking a small cut per chip to capturing the full value of each unit sold. This dramatically increases revenue per customer once scale kicks in. This shift toward a more capital-intensive model could significantly enhance long-term profitability, pushing margins toward top-tier hardware levels and unlocking explosive financial upside for investors. Before, if a customer made $100 selling a chip, ARM might only get $3. Now, if ARM sells the chip itself, it keeps the full $100. Yes, The investment is higher but the profit ceiling is gone. If the AGI CPU scales successfully, ARM's financials could show massive nonlinear growth. However, this transformation comes with major strategic risks. ARM is now stepping into direct competition with its core customers, companies like Qualcomm and Apple. This could strain relationships and potentially disrupt its ecosystem. Large clients, concerned about supply chain security, may reduce their reliance on ARM architecture or accelerate the development of alternative solutions. This restructuring of partnerships is the price ARM must pay in its pursuit of high margins. ARM's ecosystem is still strong for now, but the rise of open source architectures can't be ignored. If ARM mishandles its relationships with longtime partners, this profit grab could backfire and weaken its position in core markets like mobile. This is a high-stakes balancing act. Despite the compelling growth narrative, ARM's valuation has entered a warning zone. Its forward divided by E is around 1 to 0x, and its PEG ratio has reached an extreme 6.0. Typically, a PEG above 2 is already considered overvalued. A PEG of 6 implies that the stock price has already priced in several years of hypergrowth. At these levels, even a slight miss in earnings or gains could trigger a severe correction. A 1 to 0x divided by E isn't just buying a stock, it's buying a miracle. The market is expecting not just growth, but explosive, near-perfect execution. The margin for error is basically zero. Any negative surprise could trigger a sharp sell-off. Options data reveals a complex market sentiment. A put divided by call ratio of 0.67 suggests that short-term traders are still betting on upside. However, an open interest ratio of January 2nd indicates that many investors are hedging with protective puts. This divergence shows that while the market is right in the bullish trend, there's a deep underlying caution toward ARM's extreme valuation, with participants ready to exit if risks materialize. To sum it up, ARM is making a massive bet on redefining its future. It's targeting the rise of agentic AI with an impressive new chip, but it's also pushing its valuation to the limit. Do you think ARM can successfully transform from a designer into a full-stack supplier at 1 to 0x divided by E? Would you buy into the transformation or wait for a valuation reset? Drop your thoughts in the comments. Hit like, subscribe to Stock Market Breakdown, and I'll see you in the next one.